All right. Couple things that we got, that I figured I'll cover with everybody before Amy gets started. So, um, sorry, I got to mute some people there. When you do go out for a listing, I think that if you have the ability to ask that your current owner for a copy of the most current budget and their certificate of insurance, that is always helpful. That's always something that a lender is going to need. That also would give us the ability, let's say you're going out to a listing and you would love to know if it's going to meet the current guidelines. We can actually do a pre-approval of the condo complex with the budget, insurance. We would also ask them to fill out our questionnaire to make sure the main thing in the questionnaire is making sure that there's no deferred maintenance projects, which we'll discuss a little further. But we are able to pre-look at a condo complex, but we do need all the information. And I was saying earlier, unfortunately, many of the associations use a management company, and the management company charges a fee in order to get that information. So if there's anything at all that your seller may have access to, that could make it very easy or a lot easier to determine if they're going to meet the budgeting requirements, if they meet the insurance requirements, and things like that. The other thing too, is to ask them as you're going out there, do the listing. Do you know if there's any current maintenance projects that are on tap, or is there anything that you're aware of that they're currently budgeting in, or any type of deficiencies in the property? It's certainly great to ask that question, because if you know that information up front, that can certainly help the lender a lot. One other thing that's really is going to become important once you see the presentation is how many units are in the HOA. There is going to be some new guidance depending on the number of units in the HOA, and that's going to help. Lesser units makes it, there's a less documentation requirement for those type of projects. So I see my condo team on here now, so I am going to introduce Amy to get started, and we can get rolling from there. Amy, I can unshare if you want to just share your screen.
Oh, no, it would be very helpful for you to continue to share the slides. That would be helpful, okay. Dan. Thanks. I was actually on another realtor presentation. This is a super hot topic, so I am so happy to be here to cover this information for you. I have Tina Trulinger. Tina, you're here, right?
Yes, I am.
Awesome. Tina I am the Division Underwriting Manager for Condo at Rate, and Tina is my Regional Underwriting Manager. And she is going to tag in towards the end of the presentation because I had an unavoidable meeting I have to go to. So I'm going to cover some stuff, and Tina's going to then cover the agency updates that are happening. So let's just get right to it then, Dan, if you want to move on to the next slides. We're going to start with partnership and processes. And what we can do for you as a lender. So we could go to, I'm seeing Dan here, get the presentation moving along. You can move to the next slide, Dan. There you go. There we go. All right. How to partner with us. This is the big information, right? How can we help you, right? We want to help you close more deals. We need to make sure that condo projects are reviewed as early in the process as possible to save time, prevent surprises, and protect your contracts. We want to simplify the process as much as possible, so having these types of calls kind of help do that. The most important way to partner with us is to understand and set the proper expectations. Condo project review is very complex, and we don't ever know what we have until we start getting documents. Every condo project, it's like a snowflake. Every one is so different from another, and all the condo project information can be very different. So the most important thing is to set the proper expectations. It takes a little bit of time to collect the docs, underwrite them, and make sure that the project is eligible. But most importantly, we want to get as many documents up front as possible. The earlier we can start the review process, the better. We could definitely get in front of obstacles and potential hurdles way earlier in the process rather than like 2 days before closing. That's pretty tough. The goal is to work together and eliminate delays. So sometimes it could be a little bit of a challenge to collect documents from the condo projects or the HOAs or property managers. So sometimes partnership between sales, loan officers, condo underwriting, and our referral and realtor partners can be helpful in expediting that process. That has been helpful to kind of get things moving a little bit quicker in the past. So what can rate do for you? We have a dedicated condo underwriting team. We've increased staff considerably over the last year and a half to make sure that we can provide really high service levels. Our condo underwriting turn time is 1 business day. It is the best in the business by far. And we also review pre-qualifications. So if documentation is provided ahead of time, we do pre-qualification or what we like to call pre-flight reviews, and we'll review condo docs ahead of a loan file to see what our options are. 2 days tops for a pre-qualification review. So we have really fantastic turn times. We partner very closely with the agencies, Fannie Mae and Freddie Mac. We have actually piloted 3 programs for Freddie Mac over the last 5+ years. So we partner very closely with the agencies. We've been advised that we have great success with removing ineligible product statuses. So if you are not aware, Fannie Mae and Freddie Mac both have what we call like do not lend lists, right? Where they will put a condo project on the agency list as ineligible, and loans in that project cannot not be delivered. Our rate condo underwriting department is very successful in overturning those decisions. We work very hard to collect additional information to show a condo project is eligible and submit back to the agencies to ask them to overturn their decision. In addition, Rate Companies has dozens of investor options. So we can cater to specific borrowers and what they need to be able to proceed with the loan. So that's what we offer. What I want to share with you too, and I believe, Dan, you're going to provide a copy of this presentation out to all.
Yes, I am.
Perfect, thanks. Here on these next slides are condo document requirements. And I'm not going to spend a whole ton of time on these, but this is a list of standard documents that condo underwriting needs to ask for to determine that a project is eligible with the guidelines. So completed condo questionnaires, and those could be HomeWise questionnaires or first service residential or condo certs. There's all different types of questionnaires out there, but a lender has to have a condo questionnaire to obtain a majority of the information about a condo project. Budgets and financial documents, so that's budgets, balance sheets, income expense statements, reserve studies, those can be required dependent on the type of condo project we're reviewing. In addition, inspection reports and engineers reports or city evaluations. That's definitely something that we see in the city of Chicago is City of Chicago exterior wall maintenance program inspections. So it could be a variety of different inspection reports that we have to obtain. HOA meeting minutes, 6 to 12 months of meeting minutes to dissect to see if any concerns with the condo projects and the eligibility. If there are special assessments levied or proposed against unit owners, we have to obtain documentation related to those special assessments. So this is just a standard list so that you're aware so there's not really any surprises once a condo goes to underwriting. So what I want to cover next is our partnership. We want to make the process as easy as possible and as streamlined as possible because at the end of the day, the borrower when we have a borrower in place, we want to make sure that their transaction is smooth, not only for them, for all parties involved. So anything that we could do on the front end to try to get ahead of any potential issues with the condo project, we want to do that. So we're going to start with verifying the type of project that we have. Is it a condo or a PUD? Everyone in the process can help with identifying the project type because it's very important. Condos and PUDs do not have the same qualification requirements and guidelines that we follow. PUDs, they're super easy. Insurance, and we move on with our lives. There's not questionnaires, budget, that kind of thing. So it's very important to identify the actual type of condo or the project that the loan is for, condos or PUDs. We have to make sure that we understand that as quickly as possible.
Can I chime in there one quick second?
Absolutely.
So, yeah, in Cook County, it's fairly easy to know whether you have a condo or PUD. Take a look at the last 4 digits of the PIN number. If it ends in 4 zeros, typically then you own land. That in most cases means that you're dealing with a PUD, which is a totally different set of guidelines than, like Amy is saying, than a condo. In the collar counties, it's a little more difficult. You do need to, in most cases, get into the legal description. The first line or two of the legal description will usually tell you how that land or that property is owned under condo declaration or as, with lot dimensions as would be a PUD. So just to add on.
Perfect. Yeah, that's great pointers, Dan, because anything that you can use that you have at your disposal to identify condo versus PUD is going to save you a lot of time, right? We don't want to go chasing docs for a PUD because docs aren't needed. So being able to identify that in any way you can is pretty important. At the very minimum, we need the name of the condo association, city, state, and zip code. If that is all the information that you can obtain for a potential listing or a project that a buyer is interested in, that's going to be the most important data for us to help. And this is what we can do with that information. If you have the name of the condo project, city, state, and zip code, we have an internal company database for all of our rate-related organizations. So all of our rate companies, we have a giant condo database. If we have the project name, city, state, and zip code, we can start doing some research in the background. Have we done loans there? Do we already have documents for the project? Do we already know something about the project that we can alert you to pretty much right away with that basic information? We can also check, is the project FHA approved? Is the project VA approved? This is very good information, especially on the listing side, to know what options potential buyers are eligible for. So that's what we do, is we check all of these different resources. Our internal condo database, Fannie Mae or FHA list, VA list, and then we check the Fannie Mae and Freddie Mac list with that information. The basic association name, city, state, and zip code, we could check. Is it Fannie Mae approved? Is it Freddie Mac approved? Or is the project listed as unavailable, do not lend, ineligible? That's very, very important information to know up front because it's going to give our path forward. Can we do a standard loan here, or do we have to look into a non-QM space, broker channels? It's very, very important to know what's out there. If a project is on a Fannie Mae list or a Freddie Mac list and it's ineligible, loans in that project cannot be delivered to Fannie Mae or Freddie Mac. So those investor options direct to the agencies are not an option. So we need to know that up front. But on the reverse side, if they have an approval, that reduces the documentation that we have to request. We don't need condo questionnaires. We don't need budgets. So with just the project name, city, state, and zip code, we can get quite a bit of information for you and perform a pre-qualification review. If you partner with rate loan officers, you can reach out to them. They'll get whatever documentation that you can get your hands on, either from the seller directly. They typically have portals that they can pull docs from, budgets, insurance certificates, that kind of thing. And you want a project pre-reviewed, get it into us. We will take a look at it. So obtain all the documents that you can. Reach out to rate loan officers. They'll be able to, they have direct contact to the condo underwriting department. We'll take a look at it for you. If you can assist us in obtaining supplemental documentation to kind of close those gaps, we'll review it all and we'll provide options. Hey, this could be a potential issue, so you might be limited to only these products. We'll give you all the information that we possibly can when we pre-review the file or the project itself. The most common ineligible components that we run into on condo projects are critical repairs, special assessments, and code violations. When we underwrite a file, like I said, we never know what we're going to get until we start reviewing the documents. These slides that I'm about to go over, this one and the next couple slides here, are common denial reasons. When we get a file and we're underwriting the condo and we find critical repairs, special assessment, or code violations that are not compliant with guidelines, top reason that condo projects are made ineligible and there's no option to proceed with the loan. With the list of documents that are already provided in this presentation, we can tell whether or not it's going to meet the guidelines. With the engineer's reports, special assessments, and code violation notices that HOAs get, that's going to tell us, does this meet the guidelines or not? We do a lot of projects that have special assessments, code violations, critical repairs, but it is the top reason for denials. So I just want to make sure that that's covered. And new construction poses a challenge for us as well. We don't necessarily deny files for new construction, but they are more complex. What we do here at RATE kind of help with that. New construction has a lot of unique additional guideline requirements that need to be met. And what we do to make sure that everyone involved is aware of that is we pre-review the docs. But what's super, super cool is that I get on developer calls. Myself and my team will partner with loan officers and realtors and anyone involved in the transaction to go over the condo project with the developer to make sure that the project is set up in a way to move those units as quickly as possible and to open up the widest variety of potential lending options in that condo project. So we partner with our condo underwriting to partners with our sales to make sure that we are providing as many resources out on new construction condo projects that we can. We offer all solutions in the front end so that everyone understands this is how we get the loans done. And we have dedicated new construction department to build relationships with developers. We specialize in this at RATE. So we have a whole team that's dedicated to building those developer relationships and partnerships here at RATE. Condo insurance is the next top reason that condo projects are not eligible and they are denied. Condo insurance has to be reviewed and verified as compliant in order for the entire project and the loan to qualify. Some of the top reasons that condo projects are found to be ineligible due to the insurance are deductibles that are in excess of the 5% requirement from guidelines, projects insurance that has co-insurance provisions included on the policies, actual cash value coverage. This is most commonly for roofs, but we do are going to cover some agency updates that kind of help this one for Fannie and Freddie direct loans. Reduced property insurance coverage to lower than 100% of the replacement cost value, and limited or reduced coverage for specific perils. I'm going to give you just a little bit of insight on this particular topic. Like I said, I'm not trying to train underwriters, just to get enough information out there so that there's not a lot of surprises and you really kind of know what everything means when communicating back and forth with sales on a transaction. Condo insurance is expensive. My personal homeowners insurance continues to go up year after year after year. Now, when you look at that on a broader scale, when you have a huge condo project, the insurance costs are rising for HOA policies. HOAs are trying to find ways to mitigate those higher costs. And that's why we start to see these ineligible insurance components, because every one of these components that are on this slide result in a lower premium to the HOA. But it doesn't meet the guidelines. It doesn't allow the project to be warrantable or eligible So we try to find ways around this, but this is definitely one of the biggest reasons that condo files are denied for eligibility. I'm going to pause here because this is where I'm going to turn it over to my regional underwriting manager, Tina, to go over the agency updates that have just recently come out. But I want to be able to answer any questions that anyone has before I turn it over to Tina. Does anyone have any questions that I can answer for you?
If you do, you can just unmute. I think, Amy, then you're released on good behavior.
I was going to say, I must be really good at this if there's no questions.
And I'll say that the insurance piece, especially over the last year or two, the deductible, we've had a couple complexes down here the southwest side of Chicago that they've raised their deductible beyond the 5%. And then, I get, well, we financed one last year. Well, yeah, that's because that was before the renewal when the HOA decided to raise their deductible to prevent the insurance from going up and preventing their HOA fees from going up. And you try to educate them that, hey, we're just telling you that it's no longer fits the guidelines. And, as I was saying in the beginning before Amy came on, that's the hard part because they don't want to hear that, there's not going to be an issue getting financing. Well, it's going to present an issue. So thanks for, clarifying some of that stuff for us, Amy.
Yeah. And Dan, and just to that point as well, insurance is there to protect unit owners. And even though, it could result in us not being able to do the loan, it is there to protect the unit owners. I saw a project a couple weeks ago where the replacement cost value of a condo project was $179 million. That was the cost that the HOA had to, that's the amount of insurance they had to have. The HOA, in an attempt to reduce their insurance costs, were only covering $10 million. $179 million was the total replacement cost value, and they only had $10 million in coverage. That association was $169 million underinsured.
Wow. That's crazy.
Yeah, so we see such a variety of insurance complications that render projects ineligible. So I am very happy to have provided some more information to kind of clarify that, clear it up. But I am available for questions. So Dan, anyone that reaches out to you, you know where to find me.
Yep,
you can
sure.
send questions my way, and I am happy to answer any questions that anyone has. So with that, I'm going to turn it over to Tina. She is super fantastic, and we'll go over some agency updates. And then I'll be here if you need me, Dan.
All right. Thank you, Amy.
Yep.
Thanks, Amy.
You're welcome.
Yeah. And this is the part, that's the really, really important part going forward, right? It's really about some of these. There's a couple good changes. But as Tina will go through, there's a couple that that will dramatically affect how we do business. So
absolutely,
I'm going to work the slides, Tina. I'll try to stay up with you, and let's roll. Okay.
Good. Yeah, sounds great. Okay, so I'm obviously talking about agency updates, right? So if you don't know, Fannie and Freddie recently came out with some agency updates. Some things are effective immediately. Some things are effective a little bit in the future. What we have right now are some bulletins from them. They actually haven't updated their actual guidelines yet. So we wanted to make sure that we went over the information that we do have with you guys at sales so that you were aware of the changes, how we are reviewing files right now, and how we're going to be reviewing them in the future. So these are effective immediately. So we have already implemented these changes that are showing on this screen right now as underwriters. So the first one being that 2 to 4 units are a review type that is waiver of project review, right? And so Fannie and Freddie have now increased that to, it's now 2 to 10 units. So if you have a project in Chicago, that's 6 units, right? It now can qualify for a waiver of project review. And it is basically with the waivers, it's reduced review requirements, right? So with the 5 to 10, projects, we have an additional 5 questions right now that we are asking just in an LOX. I'm going to put that in the chat for you guys before I leave here, just so you have them. The condo processors are aware of this update. These questions do not need to be asked and answered on the 2 to 4 units, but it's just the 5 to 10 units. And it's asking the insolvency question. It's asking if there's any critical repairs. It's asking if it's part of a master association. These are just some additional requirements that the agencies came out with for the 5 to 10 unit waiver. Once we get those 5 questions answered, all that is needed for us to review then is the appraisal and or title and the insurance. So it's a really good thing because it just makes those, as we know, with those 5 to 10 unit projects, sometimes they don't have everything that we need, right? So it's sometimes getting those smaller projects to have all of the required financials and things like that can be challenging. So this makes it easier because these are items that we're not going to need on those smaller projects, which is really good. And so we've been utilizing this since this came into effect a couple weeks ago. So you guys might have noticed that, but it's a really good update that we're really excited about because it just really helps with those smaller projects. The second thing is
we don't need to worry about Florida. We're not in Florida.
Yeah, okay, awesome, great, that's great. Okay, so then the last thing is investor concentration. So if we were doing a loan with the subject unit being an investment project, an investment unit, right? So non-owner occupied. It used to be that we would have to require 50% owner occupancy in that project, and that has gone away. So if you have an investment unit that you are working on and that project has less than 50% owner occupancy, we are able to proceed without having to get anything else. This is not to be confused with single entity ownership. Okay, because there's been a little bit of confusion with that. Those guidelines are still the same. If a single entity is still only allowed to own, 20 to 25%, depending on if we're utilizing Fannie or Freddie. This is just investor concentration of the projects, the units in the project itself. So we just don't have to worry about the 50% requirement of owner occupancy anymore on investment units. So
I'm going to add on a little bit there, Tina.
Absolutely.
There was this misnomer that it used to be years and years ago that even on owner-occupied properties, if somebody was buying a condo, that there couldn't be more than 50% investors or renters in there. That guideline was gone a long time ago. We've been doing 80% investors in there purchased for an owner-occupied property has been fine. But now this is kind of leveling the playing field where it doesn't matter if it's owner-occupied or investor. No longer do we care about how many renters are in there.
Yeah, doesn't matter. Yep, we're good to go regardless, which is awesome.
It's a good change. Yes.
It's a very good change.
Yeah.
And then the next slide is even better changes. So this is insurance changes. And these are what we have noticed have been the most impactful in a positive way. We've had a lot of loans that were in the pipeline that we have been able to turn around due to these changes. So first thing, per unit deductibles are now allowed up to $50,000 per unit. It doesn't matter what the percentage is. We are no longer capped at the 5% of the policy. It doesn't matter. Per unit deductible can go up to $50,000 per unit, period. The biggest change with this is that if there is a per unit deductible on the policy, the borrower is required to obtain HO6 to cover whatever the dollar amount of that per unit deductible is, even if the policy is all in including betterments and improvements. Because in the past, if it was all in including betterments and improvement, then HO6 was not required. If there is a per unit deductible, HO6 is required no matter what, because the borrower has to cover whatever that per unit deductible is. Okay, so this has been huge because we've had a lot of, like you had said a little bit ago, Dan, talking about how we had over 5%. There were a lot of policies that had their deductibles over 5%. Having the per unit being allowed up to 50,000 has been huge. So it's great, and we're really, really excited about it. And like I said, we've had a lot of loans that we've been able to they were suspended, right? We were trying to work on it, and then we were able to just approve them with the deductible as long as it doesn't exceed the 50,000 per unit. So that's number one. Number two, this one isn't huge, but its inflation guard is no longer required. So we don't have to ask for it anymore. It just doesn't matter. So, which is awesome. And then ACV is now allowed on roofs. And that's an amazing update. So as we have all seen, right, and in order to save money, right, and save on their premium, a lot of HOAs have started covering ACV on their roofs only. And there have been some, you know, we were able to try to work it if it was, you know, the roofs weren't this, you know, this old or whatever, then we might be able to make it work. But it's been a huge challenge. And now if ACV is part of the policy, as long as it's just on the roofs, we're allowed to proceed. We don't need anything else. We don't have to ask any additional questions. We don't need anything. It's just we're good to go as long as we know that it's on the roofs only.
So just to say, ACV means actual cash value.
Yes.
That is typically not enough money to replace the roof. That is replacement cost coverage. Mm-hmm. So it's different. You know, actual cash value is what the worth of the roof is basically at that, not at that time when it was put on. Tina, I'm trying to explain it.
Yeah.
It's a big difference.
Yes, it's whatever the amount is with depreciation, right? So however much the replacement cost would be, but with the depreciation of what it's worth right now, right? So it's not 100% replacement cost. A lot of the times it's a large percentage less than that. So, and for the longest time we weren't able to do that, and now we are, which is awesome. Okay, let's talk about the future updates. These are the ones that are definitely going to be a bit challenging. Limited reviews for loan applications that are dated August 3rd, 2026 or after. We are no longer allowed or going to have the option of doing limited reviews. They are gone across the board for everybody and every state. It's no longer an option.
Can you take a minute to explain the difference of the documentations, Tina, for everybody on the call?
Absolutely. Yes. Yeah. So with a limited review right now, we are able to, it's basically if it is a primary residence, right? So, and it is a 90% LTV or less, or if it is an investment unit, if it's 75% or less, or 80, oh my goodness gracious, Tina, 75% or less, we are able to do what is called a limited review, and that's limited documentation. So all that we need to look at is it's a limited questionnaire, and then we are looking at the insurance and we're looking at the appraisal, right? We're not looking at the budget or additional insurance requirements or anything like that. They're an easier review type that has a lot less documentation than a full review. With a full review, we are having to look at the questionnaire, and then we have to look at the budget, right? And on the budget, we have to make sure that it meets the reserve requirements, which right now are 10%. And there is also fidelity requirements on the insurance for a full review, where we have to make sure that the HOA has enough fidelity coverage to be compliant with guidelines. And that those two things are definitely something that we make it easy right now, because if we look at a budget and we can say, oh, we don't have the reserve allocation, can you put more money down, and we can just look at a limited review, right? So we'll just remove the requirement for the budget because it doesn't meet the guidelines, and then we'll just offer a limited review and we'll move on. That is no longer going to be an option for loan applications dated August 3rd, 2026 or after. So that is, it's going to be a huge impact to the way that we are looking at loans, and which is why we're trying to give everybody as much time as possible in order to know that this is going to be coming. While the other updates, we are using those and we are implementing them right away, we are not doing that with these updates. These updates we are, because I don't want to say that they're bad, but they're not super positive, right? These are going to be a lot more impactful. So we're waiting until the last minute pretty much in order to implement these, because we don't want to just make these changes immediately. We want to give you all and the time to be able to adjust and know that this is coming, right? The second thing is reserve studies we don't use reserve studies a lot when it comes to budgets right now, but they are an option that we are able and have been able to use when the HOA budget doesn't have the required 10% reserve allocation. We can obtain a reserve study and we're able to utilize what the reserve study shows the HOA should be contributing. And as long as they're following the reserve study, we're able to use that. With these future updates that this is effective on for the loans on August 3rd as well, is they're basically making it a lot stricter. And when you're looking at a reserve study, right now we look at what the minimum amount that their requirement is. The guidelines are changing to the highest level of contribution is going to be the requirement. So when you have a reserve study, a lot of the times it will show minimum and then mid and then what the highest amount that should be allocated in order for the HOA to meet whatever the reserve studies requirements are. The guidelines are going to be updated so that they are required in order for us to use the reserve study. The HOA has to be contributing the highest level of contribution that is listed on the reserve study, which is going to make it almost impossible to use. Like that's just
to
not
chime
something
in
that
too.
we see. Mm-hmm.
Yeah, I mean, I can count on one hand in the last 10 years how many times we've gone to a reserve study.
Same.
Because they're only putting in 5%.
Yes.
And what we mean by, when we say the 15% or the 10% you're seeing on the screen reserve allocation, let's say that the HOA has $100,000 of income coming in every year. 10% of that $100,000 has to be going into a specific line item on the budget for reserves, right? So that's what we're referring to. And this is not arguably the most common issue we run into on the condo HOAs.
100%.
Hands
with
down.
Budget. Yep.
Right.
100%. That's the biggest challenge.
Right. And we'll go to the management company and say, we have one right now, that we're working on. Hey, you probably don't realize that your budget is not meeting the guidelines, but here's a couple adjustments you could make and get it to be in line with what the requirements are. And, a lot of times instead of saying, oh, thank you, because a lot of companies, banks, they'd look at the budget, see it's not meeting the guidelines, and it's dead. There's no working with the HOA and educating them. The company denies the loan. But it's amazing to me that, you try to bring this information to the HOA and the management company mostly and say, listen, here's what you can do. And they throw their hands up and say, well, we're not changing it. Right. Instead of embracing the fact that maybe they just didn't know the guidelines. So the next item on here is the big one. It's really going to make it hard.
It is. And that is that the requirement for the reserve contribution is going to be increased to 15%. And this is going to be effective January 4th, 2027. And it is really important that we get this information out there now, right? Because most HOAs are going to be looking at and approving their budgets for 2027 in the last quarter of 2026. So between September and November, a lot of the times is when they are having their annual meetings and they're talking about the budget for the next year and they're approving it. So we want to make sure that we are educating as much as possible all of the HOAs and any of the management companies to let them know that for their 2027 budget, in order to be compliant with guidelines, they do need to increase their reserve contribution to 15%, right? And we want to try to get them before they approve their budget for 2027, because as we all know, it's very difficult for them to update or change their budget in the middle of the year, right? It's not something that we see very often. So as soon as we found out about this, we wanted to share it with all of you so that you knew and that we can all just try to educate as much as we can to know that this is coming. Because where this is going to be a domino effect, right, is that right now it's 10%. And if they don't meet the 10% reserve allocation and we can't get the budget to work, we can switch it to a limited, right? We can say, let's put some more money down. We don't have to worry about the budget. Well, that's no longer going to be an option because limited reviews are not there anymore, right? So the 15% requirement is going to be the 15% requirement. There isn't going to be a way around it. So we want to make sure that everybody is aware that this change is coming, and then hopefully are able to get most of the HOAs on board to have that 15% allocation in their budget. It's super, super important that everybody is aware of it, but it's a big deal, right? And that's why we're not doing anything until we have to, which is on January 4th of 2027.
Well, and that's, just to add on, the fact that the limited review option is going away, that,
Yes.
can you come up with 10% more down, and then we don't need to deal with the budget.
Right.
This is arguably, it's a double down effect on,
It is.
on the HOAs. I mean, we're having a big enough issue dealing with the deferred maintenance. That's just another whole animal that for years and years and years, until that condo complex collapsed in Miami, no one ever asked about the maintenance or the, anything going on with the building.
Right.
You had to meet guidelines. And then when that building collapsed, Fannie Mae and Freddie Mac came in and said, listen, we don't want to be doing loans in these projects that have engineering issues, deferred maintenance issues, that are health and safety issues, right? So they added the questions to the questionnaire, asking those specific questions. And I'm looking at an email right now where they had I think it was $150,000 project what they took a loan out for, and we're just asking the management company right now, well, can you confirm with us the work is complete? And here's the response from the management company. The manager stated to let you know that the customer's home inspector should be able to verify that. The home inspector has no idea what the repair project was that cost $150,000.
Right.
But this is what we're dealing with on our end when we're trying to move along through the process and get this HOA approved. The obstinance of the management companies to not want to say, hey, listen, that's not the answer to the question. What was done, and is it done? Did they have no balconies? All the sidewalks have to get fixed. So it's it's only going to get more complicated with the fact that there's no more limited review. Okay.
Absolutely.
Leading us into there are non-warrantable options.
Yes, we do
okay.
have other options. Yes, we have, and non-warrantable. I believe that we were looking, and I think altogether, I think we counted the other day that we have like 153 investors, right? And a huge percentage of them are non-warrantable, right? That they give us options in order to take a different route for these loans that don't meet, don't fit in the box, right? And so non-warrantable condos are something we do a huge percentage of them now, and it's great and we love it. So I wanted to go over some of the common non-warrantable characteristics. I find it funny, you can tell that this this is a little bit older because the very first thing listed on here is the investor concentration, which has just been updated. So that's no longer a common non-warrantable characteristic, but it was. So because, it's less than 50%, we don't worry about that anymore. So, but some other common non-warrantable characteristics that we see is commercial space greater than 35%. Single entity ownership is greater than 20%. For new projects, pre-sales don't meet the 50% requirement. The HOA delinquencies are greater than 15% of the units are more than 60 days delinquent on their dues. Again, like we just spoke about, the reserve allocation is less than 10%. Litigation, if it's minor, sometimes we can get that to work non-warrantable depending on what it is. Condos, those are, that's always a non-warrantable characteristic that we do allow, the national chains and short-term rentals and things like that, condo characteristics or hotel characteristics are non-warrantable. And then the deductible, again, so here's another item that is no longer the case, because we don't care if it is greater than 5%. We care about if it's a per unit. So, but those are most common of the non-warrantable characteristics that we see. And so, on here it states that about 10% of all condo projects are non-warrantable nationally. So, and I think it's more than that. A lot of the times I feel like that's a good percentage of what we've been doing, right, is non-warrantable. I know for me personally, I don't underwrite as much as the underwriters anymore, right? Because but I do help on the regular, and that's a huge percentage of what we do, because it is an option, and why wouldn't we, right? If we have some way to be able to try a path forward, we're going to do that. So we partner with non-agency, non-QM investors across the industry, and then we work with them and know a lot of the times, because we've been dealing with them for so long, like what their appetite is, right? For the gray area deals, things that, don't necessarily meet the standard agency guidelines, but we can make it work a little bit, right? There's a lot of all of this middle portion here where we're talking about commercial space, single entity ownership, pre-sales. A lot of our non-warrantables have that in their guidelines as something that's accepted, right? So we know that they will allow pre-sales that are, less than 50%, or that if the commercial space is at 50%. So we know that. And we have a whole non-warrantable portion in our resource center that actually breaks down all of our investors and what their overall guidelines are, and what they allow and what they don't, right? There is a price rate adjustment. Obviously, we don't have anything to do with that, but it does, a lot of the times, if it is a non-warrantable lender that we're doing it, it's going to be the pricing is going to be a little higher. Documentation is huge, right? One of the things that with our non-warrantable condos that we can do is all of our non-warrantable lenders do have their own non-warrantable guidelines, right? So they have a list of what they will allow, right? And sometimes the project or the file that we're working on doesn't fall within their guidelines. That doesn't mean that we can't keep going though, right? Because we can try to get an exception from one of our non-warrantable investors for whatever it is that we're looking for. So, let's just say that if you have a project that has commercial space that's at 60%, and we can look at our edge guidelines, our edge non-QM, they only allow up to 50%, right? But we can send in the file to them and say, hey, can you look at this for 60% commercial space? And that's where the documentation is crucial for flexibility, is important, because the more documentation that we have and the more information that we can give to the investor to kind of quote unquote sell them on why we think that this is something that they should do, is the best thing, right? Because we try to present them with the best case of why this is a good idea, why this is a good risk, why this is something that we feel they should lend on, right? We don't feel it's a risk because of this, or especially in Chicago, and specifically with commercial space, right? A lot of it is that's standard. It's they're standard with and they've been around forever, right? These are projects that have been around for a really long time. This isn't new. We know that it's very low risk, things of that nature that we're able to communicate to the investor and let them know, hey, these are the positive attributes of this file, of this project, and we feel that it's worth lending in. And we've had really good success with it. There are some, sometimes they'll come back and say no, but a lot of the times that is in reference to critical repairs, right? That's really where the super gray area is. But a lot of the times when it doesn't strictly fall within the non-warrantable guidelines, we can keep pushing and hope that we can get that exception. So that's,
thank you.
That's what, yeah. Mm-hmm.
Yeah. I mean, unfortunately for all of us on the call, in most cases, we don't know we have any of these issues until the offer's accepted. If it's your listing, that the seller, a lot of times in these projects, these larger ones, they don't have any idea what's going on in their own HOA in some instances. They're probably they're getting their minutes of the meetings and they're getting their updates, but are they reading them? Do they really know what's actually going on? And that's the issue being is that we could be 1, 2, 3 weeks into a deal before we're unwrapping this thing and going, wow, okay, we've got issues, and it's upsetting for all of us, right? I mean, I'm on a deal now where a listing agent was quite upset with me that I didn't get a copy of the budget from day one, and it's like the management company, we have to hire them. They require a fee to get it,
Right.
So, we don't have access to everything to make the decision on day one. And it costs people money, whether it's home inspections for the buyer, appraisals for the buyer, only to find out now they can't get a loan in that complex. And then if it's your listing, you're stuck with this listing going, what do I do? Right. It's great if we have a management company and an HOA association that is willing to open their minds up to learning and complying and adjusting, I should say, to the new world we live in. Unfortunately, many are not. So, kind of ended. Anyone have any questions? I mean, feel free to unmute or type them in the chat before we go. But really just want to say, we're here to take a look at stuff firsthand for you. If you're going out and taking that listing, right? Try to get as much information as you can. That the owner of the unit has access to this information free. Now, as soon as I request it, I have to go through the management company, and they're going to charge me for it. Some of the things like the budget that they should have access to for free. So, if you're able to gather up some of this information, we certainly would be happy to dive in. A lot of times it could be, okay, the budget looks great, but without sending somebody our questionnaire to get filled out to know that there's a deferred maintenance project, right? Or that there's one person who owns 38% of the units, which is going to make it non-eligible. We don't know all the answers unless we can have somebody actually complete the questionnaire and get some more information. So it's a tricky world, but I felt that these new changes, especially with limited review and the 15% adjustment on the budget, was something I needed to be kind of shouting from the top of the mountains on, and hope enough people hear before they go and do their budgets for 2027, like Tina said. So before we let everyone go, I'm going to share the presentation again, and then there will be a recording automatically of this that'll go to everyone who attended. But feel free to type them in real quick or unmute. Well, it's just like when I do my own little regional calls. Nobody ever has questions.
I got a question.
Perfect. Yay.
If there is an offer accepted and loan started, and we're in process by August 3rd, can that close under the old guidelines?
As a limited, like if you're, for example, yes, as long as the application date is August 3rd or prior, then we're fine. Yep, we just need the application date. Yes. Yeah, the application date just has to be August 3rd or before.
Okay, thank you.
Sure.
Well, thank you everyone for taking time. Tina, definitely thank you for going through it all. More to come, right? We'll keep updating everybody, and certainly just want to be your resource to help you in any way we can, so we can all be successful and really help people buy places and sell places. That's the goal of what we do every day. Okay. Oh, we got one question. What is the path of least resistance in making an inquiry about whether a condo is on the do not lend list? If you send us the name of the HOA and the city it's in, we can look it up. It gets a little tricky because sometimes they could be Aardvark condos phase 4, right? So
Mhm.
get us as much detail as you can, Mike, and email it over to us, and we'll look it up. And anyone can do that. So go ahead.
Mhm.
I have another question, and you might have covered this, and I maybe was not paying that much attention at that moment. Sorry. Is there a specific insurance that the condo HOA needs to have for the loans that allow younger people to buy, like their elderly parents, a property?
No, there's nothing specific on that, Denise. So that actually is a guideline. It's called a family opportunity mortgage. And it doesn't matter what the property type is. The regular type of insurances that the condo would have to have would be applicable.
Okay, thank you.
Yes, you're very welcome. All right. Well, thank you again, everyone, for joining. Hope everyone has a wonderful day, and let's get out and do a bunch of limited reviews before that goes away. So, all right. Take care, everyone.
Thank you all. Bye-bye.
All right. Bye.